My name is Farhan. In this video, you will solve question number 12 from 2019 Paper 2 Past Exam. This question requires you to find the net present value and the payback period. Make sure to like this video and subscribe to my channel so you can get notified on more videos that I'll be uploading on a daily basis. We are now going to start the question. Tab Limited is considering upgrading the production facility by investing in a new high-tech machine. The following information is available about the machine. So we are given the original cost of the machine, the estimated residual value, which is the disposal proceeds that we can get by selling the machine at the end of its useful life. We know the useful life is 4 years. Profit for the year at the end of year 1 is expected to be £35,000 and is estimated to then increase by 10% per annum year on year. The machine will be depreciated using the straight line method. The discount factors for a 12% cost of capital. Now, the 12% cost of capital here refers to the minimum return that Tab Limited requires by purchasing this machine. If they're purchasing this machine, they would require a minimum return of 12% as a result of using this machine in terms of upgrading the production facility. And we are given the relevant discount factors for every year. The requirement of the question is to first find the net present value and then also the payback period for the machine. Now, we first need to find the depreciation per annum. So you can get to see the workings on the right-hand side of the screen. Now, depreciation per annum, because we're using the straight line method, can be calculated by taking the cost and subtracting the residual value and then dividing with the useful life. So the cost is given as 194,675, and then the residual value at the end of the useful life is 34,675, and the useful life is 4 years, which gives us a depreciation of £40,000 per year. Now we understand that depreciation is a non-cash expense. So what do I mean by that? Why is depreciation is a non-cash expense? Depreciation reduces reported profits, but there is no actual exact cash outflow. Depreciation simply refers to the loss in the value of a non-current asset as it gets utilized within the business to help the business generate more revenue. And because that non-current asset is helping the business generate more revenue, that non-current asset loses its value over time. And the reduction in that value is what we expense and call a depreciation expense. So it's not an exact cash outflow. That is why we classify this as a non-cash expense. Now, the reason we are talking about depreciation as a non-cash expense is because if you want to find the cash flow for any given year, we start with the profit and then we add back depreciation always because it's a non-cash expense and does not represent a cash outflow. So in year 1, we're given the profit of £35,000. And on the right hand side, you can get to see the calculations for cash flows for every year. So in year 1, we started with the profit and then added the depreciation of 40,000, and the total cash flow is £75,000. In year 2, we understand based on the requirements of the question that profit is supposed to increase by 10% every year. What that means is if you want to increase profit by 10%, you take the profit from the previous year, which is 35,000, and then multiply with 1.1. So 1.1 here refers to the 10% already incorporated in our calculations. This can also be written like something like this: 35,000 times 1 plus 10%. So that is the same thing as writing 35,000 times 1.1. And because you are in L levels, I've written 35,000 times 1.1 straight away. Then we are adding the depreciation expense again, which is supposed to be constant every year because we're using the straight line method. And that gives us a total cash flow for year 2 to be £78,500. We repeat the same thing for year 3. You can see in year 2, once you do this math, you would see that the profit was 38,500, which is again compounded or multiplied with 1.1 to reflect the 10% increase. And then we are adding an extra 40,000 because depreciation is a non-cash expense. And that gives us total cash flows for year 3 to be 82,350. Now that we're moving to year four, in year three, we knew the profit was 42,350, which now has been increased by multiplying with 1.1 to reflect the 10% increase from previous year, and adding the 40,000 for depreciation expense separately to get 86,585. However, you should not forget one more thing. In year four, we also have another cash flow, which is the salvage value or the residual value. Because the residual value refers to the amount that we can sell the machine for at the end of its useful life. Since the useful life is 4 years, at the end of year four, there's also this additional cash flow referring to the likely residual value that we expect to receive at the end of year four. So now, if you take a look at the left hand side, you will see that I have already prepared the table in advance, the outline in advance. So we have different columns for year, cash flows, discount factor, and present value. So we have 4 years in total, but you need to still start with year zero to also record the initial investment. So we have year zero, one, two, three, four. And you can see we have repeated four twice. One for the cash flow that we have found by adding the profit with the depreciation, and then the cash flow that refers to the salvage value or the residual value or the disposal proceeds at the end of the useful life of year four. So in year zero, we have shown the cash flow to be negative 194,675. This refers to the purchase price that will be paid for the machine, which is the cost, because if you're paying for the machine, it refers to a cash outflow, and cash outflow means that it's a negative cash, obviously. So that is why we are showing the amount in negative to reflect that this is an investment, this is a cash outflow. The discount factor for year zero is always one, although it's not given explicitly in the question, but you can memorize this, it's always one. And the present value in year zero is simply multiplying the cash flow with the discount factor, which gives us a negative 194675. Now we're going to repeat the same things for year one to four onwards. So in year one, based on our calculations, the cash flow was 75,000, which is what we have included here. And then the discount factor is 0.893, which is given in the question. You multiply this to straightforward and you get the present value of 66,975. So the discount factor is essentially here to calculate the present value by multiplying it with the cash flow. We repeat the same things for year two and year three and year four with the relevant cash flow, and then you get all the present values. And then we also include the residual value in year four, which again we have to multiply with the same discount factor as the previous line. And whatever you get, you need to add all of this together. So one minus, okay, so all of this together you got to add in the sense that you start with minus 194675, then you plus 66975, plus 62565, plus 58633, plus the other two, and you should get 7169 as the net present value. And why is this the net present value? Because we are taking all the future cash flows starting from year one to year four and also subtracting the initial investment in year zero. That's why we are getting a net present value of 70,169 in this case. Now we're going to move to finding the payback period for the machine. And this is where I've seen a lot of my students, they make mistakes at times. So I'll break it down fully for you. Now, payback period, if you want to find payback period, you could memorize the steps that I'll be showing you now. It's more of an intuitive approach to finding this number correctly. And because you're in L levels, you cannot expect the question to give you us to help you find a straightforward answer. Rather, it has to come with complications. So first of all, we understand that we have 4 different years. This time we're starting from year 1. So year 1, year 2, year 3, year 4. So in the second column, I've shown the cash flow. And the cash flow is what you would remember based on the previous steps we've done. For year 1, we got 75,000. For year 2, we got 78,500. For year 3, we got 82,350. And for year 4, we had 2 cash flows. So I've just added both of them together, which is 86,585 added with the residual value of 34,675. And that gives me 121,260, just to make everything simple. So what I'm doing now is creating a third column, which is what we call the cumulative cash flow. And you will understand the meaning of cumulative cash flow. So you can see at the end of year one, the total cash flow we had so far was 75 grand. There was nothing else. But at the end of year two, if you want to find the cumulative cash flow, it's both year one and year two combined. So that is what it simply means by saying cumulative cash flow. I hope you get the idea now. Now, when you move to year three, that means you got to add everything from year one all the way until the end of year three, which gives you 235,850. And when you move to year four, you have to add everything all the way starting from year one all the way until year four, and that should give you 357,110. So once you got all the cumulative cash flows sorted in the third column, I need you to look back at the initial investment. Now, the initial investment is 194,675, which is the cost of the machine or the purchase price of the machine. This is what we have to recover. Payback period simply means how long it takes for the business to recover the initial investment, which in this case is the purchase price that we have paid for the non-current asset, which is a high-tech machine. Now, we can just take a glance in whatever we have prepared so far for the payback period, and you will know straight away that you are recovering the initial investment of £194,675 in between year two and year three. As you can see at the end of year two, the total cash flow you already had was 153,500. At the end of year three, you already had 235,850, which reflects the fact that you have recovered your investment sometime in between year two and year three. Okay, so what I'm going to do here now, make sure you learn this very carefully. So you see, we have 2 points that we have identified, year two and year three. So what I'm going to do is I want to calculate how much amount is still left to be recovered at end of year two. We know the total amount to be recovered is 194,675. We subtract what we have recorded so far at end of year two until end of year two, which includes both year one and year two. That means you are still left to recover 41,175. So where are you going to recover this 41,175 from? From the cash flow that you're receiving in year three. So if I was to find the payback period, we both of us understand that it's minimum of two, so it's two plus something. So what's the something that we're referring to? The amount left to be recovered is 41,175, and that is what we will be recovering from the next year's cash flow, which is year three's cash flow of 82,350, right? So we are left with 41,175 to recover at the end of year two, which is obviously what we will be recovering from what we have gotten for year three, which is 82,350. And that makes it 2 plus 0.5. When you do the maths and the payback period, comes out to be 2.5 years.